Well, we would be staying with the GDP figures and what is expected for 2026 this afternoon. The governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso, late last week said the country's gross domestic product declined by 0.25% in the third quarter of 2025 compared to what we had in second quarter. Mr. Cardoso explained that although Nigeria's GDP expanded by 3.98% in Q3 of 2025, a growth higher than the 3.86% recorded in the same quarter of 2024, he noted that the figure fell below the 4.23% growth recorded in Q2 of 2025. He disclosed this during a second half 2025 statutory briefing before the Senate Committee on Banking, Insurance and Other Financial Institutions, chaired by Lagos East Senator Adetokunbo Abiru. Mr. Cardoso attributed the growth recorded in Q3 of 2025 in relation to Q3 2024 to increased activities in crop production, ICT, real estate, and the financial and insurance sectors. Now, he added that the key contributors to broad-based growth includes crop production, ICT again, real estate, and insurance space. Well, my guest is an investment analyst. She works with Chapel Hill Denham, Nabila Mohammed. Nabila, it's good to see you. Good afternoon, and thank you for being on the show today.
Good afternoon, Mr. Tolu. Thank you for having me.
Yes. I would like to ask first and foremost, what was the projection for GDP from Chapel Hill? What were you thinking? For the fact that we had over 4% in the second quarter, and in the third quarter, we are now staying at about 3.86%. Some analysts are worried about these figures, and there's been this back and forth. Now, why did we have to have that decline? How does it come to you? What were your projections before now?
So most definitely, we were expecting a much stronger number. In fact, we're expecting along the lines of 4% for Q3 2025. But then again, there are some things that you already highlighted and worthy of noting. And the first thing that stood out for me with regards to the report was the agri sector's performance in Q3 2025, which I would say was quite remarkable because that's like the strongest quarterly performance from the agricultural space that we're seeing, looking at the rebase numbers, and even as far back as pre-rebase period, is one of the highest we've seen in the past 5 years. It would just include the pre-rebase period. And that alone just spoke to the fact that there is a lot that can be done in that space. But one thing that was not surprising to us is the fact that the Purchasing Managers Index, had already preempted the fact that agricultural sector would perform very well because for 15 months, we've seen that activities in that space have remained in the expansionary terrain, and that just spoke to the stronger GDP print that we saw the sector record in Q3 2025. So, number one, it wasn't the figure for the overall GDP was not necessarily in line with our projection, but we were positively surprised by the performance of the agri space, and based on what I've already told you, which is regards the Purchasing Managers Index, already giving us that leading indication that the growth in that sector was going to be strong, and that was what panned out when the report was out.
But services sector for me is another space where we really used to do so pretty well. I know the services sector used to drive growth in Nigeria's economy and of course GDP, but this time around it slowed down a bit. Are you worried about that? Then what about other sectors like agriculture? The real estate sector is also doing pretty well at this time, and some other new sectors coming up. How does all of this? What are you learning around it?
Sometimes the performance of different sectors is based on season, and if it is not the season for that sector to perform extremely well, then we definitely see a slowdown in growth. And I believe that's what just played out in the services space. If we're even being specific about the subsectors under the services space that, largely used to contribute to the growth and not just contribute to GDP, but contribute to the accretion in GDP. We're talking about the likes of the financial services, we're talking about the likes of insurance, we're talking about the likes of trade, just like you mentioned, and likes of real estate. So if the activities for that particular quarter in these sectors did not really improve compared to the previous quarter, then we'll definitely, see a slowdown. And the question to whether I should be worried, well, services are generally our economy has been services driven for a good number of years in the past. Uh, before we, before we had before we used to have agri drive, growth way back in the 1960s, but with services coming into play, telecoms, ICT, and the performance of those key players in that space, we started to see services account for so much in terms of contributing to GDP. So it is an area that indeed we have to focus on. If there are policies that will be favorable to the players in that space, why not? We like what they have done with the telco space in terms of the tariff increase. So definitely output from the players that play in the ICT should improve, especially as we are in this final quarter. There's a lot of data usage, and that will feed into the output that is coming out from that space. For the financial services that have also contributed largely to services sector growth, we've seen that the high interest rate environment has been favorable to the financial institutions over the past 3 years, given the tight monetary policy stance, and we've seen them record very significant, huge numbers. We've also seen interest in the insurance space as well, with the whole recapitalization and output and the transformation that has come with the recently introduced act for that space. So that alone will drive some level of growth. So we should see improvement even in terms of subscriber base. Just speaking to ICT again, in terms of growth in subscriber base, we should see that improve over the coming quarters, and that should support an improvement in the services sector growth going forward.
Brilliant stuff. Now, you talked about tight monetary policy stance of the Apex Bank, which is something that I've had analysts on this program. They've had their views around that, saying, well, they didn't really expect the Apex Bank to hold on to rates, considering what happened at the last MPC meeting where there was a bit of shift. I don't know, I haven't gotten your reaction to that. I think I should ask you what you make of the tight monetary stance of the Apex Bank, despite the fact that at the moment inflation stands at 16.05%. Many expected that there was supposed to be a shift, even if it was a slight shift of the Monetary Policy Committee.
So in-house, we're actually expecting a rate cut to the policy rate. We're expecting it to be within the range of 100 to 150 basis points. But to our surprise, indeed, the policy rate wasn't cut. But it took another dimension in terms of, being dovish in quotes. And what did they do? They adjusted the asymmetric corridor. And that adjustment in asymmetric corridor was as much as 200 basis points drop of cost in the rates for both the SLF rate, that standing lending facility rate, and the standing deposit rate. So it just meant that in as much as they are keeping the policy rate steady, and their reason was largely because inflation is still, stubbornly high at double digits, one would question why they did not consider this particular reason when they cut it in September. But then again, they mentioned that that is the reason why they are leaving the policy rate unchanged. And there is also the expectation that because of the low base we are coming from, based on the rebase figures for the CPI, we are likely to see December inflation that would come out in January print as much as close to 30%. And the reason is this: we are coming from a rebase figure, prior. So it's going to have that very low base impact when we are computing year-on-year inflation for December, because year-to-date, inflation year-to-date is around 28%. So if we continue to add monthly inflation of 0.6% on average for this year so far, we definitely get to around 29% for December when it is printed in January. So I believe all these things were put into consideration during their meeting last month, and they decided that they would have to just wait and see the full impact of the rebasing take place when we start to see January with inflation print in February. And you know that their first meeting has been scheduled for February, meaning they are skipping January just to observe at least 3 more inflation prints. That's the one for November that will come out later next week, the one for December that will come out in January 2026, and the one for January that will come out in February 2026. So these are the inflation prints that they would, watch out for before they meet in February next year. So I believe these are some of the things that they considered that make them to hold the policy rate steady. But then again, they reduced the rates around the corridor, and that just meant that banks, for instance, are no longer getting as high as what they used to get previously based on the former asymmetric corridor. They are now getting 22.5% if they deposit with the CBN, and if they borrow from the CBN, they are getting they are going to pay 29.5%. So these are some of the things that I believe were put into consideration when they met last month.
Now, when we talk about growth, inclusive growth is what Nigerians would expect considering the fallout of the reforms. Now, growing at 3.98%, it's not really at par with our population growth. You will agree with me. And they say that if we are not growing ahead of our population growth rate, that means more people are falling into the poverty line. So now the issue of intervention comes in. That's the fallout of the reforms. What sort of interventions should we be looking at as we get into 2026? Don't forget, the implementation of the tax laws will also commence in January, which is already generating concerns from all parties. So how do you see the economic indicators coming up in the new year, matching up with these challenges ahead?
So my approach to answering this question will start like this. Next year is going to be a pre-election year.
Yes.
And if we look at the past pre-election years, specifically the past 3 pre-election years that we've had, I'm speaking to 2014, 2018, and 2022. Let's address what the indicators were in those years. Starting from exchange rate. Exchange rate on average depreciated by 4.6% in those 3 years. So we should be expecting some level of depreciation, not devaluation, but depreciation in our exchange rate, because of pre-election activities and other factors that could potentially have an impact on our exchange rate, maybe due to seasonal demand and, investors just trying to stay on the sidelines and observe how the pre-election activities will pan out. So we may see that play out. But then again, some other factors look like if we're expecting at the minimum maybe a 10% depreciation in our exchange rate to around the levels of 1600, there are some factors that may likely bring it lower, and I'll be happy if that happens. Number one, we are seeing our FX reserves at the highest level ever since in the past 3 to 5 years, and that is a positive thing for the country because it means our import cover over measurement is much stronger compared to what it used to be. We are recording about 10 months of worth of import cover in terms of the measurement that the current FX reserve gives us. Another thing is the transparency that has happened in that space. And even when you were talking about the news just now, you mentioned that 82 DBTs have been licensed. So even the parallel market or the unofficial market is not left out in this transformation. These are some of the things that could potentially leave or have a positive impact in terms of depreciation of the currency. And we all know what having a strong currency would do, especially for the consumer goods companies that have that import leg in terms of doing their business. So that would positively impact their performance, notwithstanding the fact that we're expecting a depreciation because it's going to be a pre-election year. That's for FX. For inflation, the CBN governor has to re-emphasize the fact that they are making sure to sustain the disinflationary trend through 2026. But then again, how much of this inflation would occur for them to be emboldened to cut interest rates? Because in as much as they are adjusted the corridor, the policy rate is still the benchmark rate that guides a lot of other instruments in the market, especially with borrowings for consumers. So that is something that they would have to watch out for them to be able to cut interest rates in 2026. But we are expecting that they will still go dovish. It's just the magnitude of dovishness is what we are pegging at between 150 to 500 basis points cut in the MPR next year. And that will be determined based on how we see this inflationary trend being sustained over or through the course of 2026. Now, in terms of growth, we understand that this inflation as well as effects are very important, ingredients in how macroeconomic indicators pan out and how businesses go about their business in the environment that they find themselves. So, if those two are as we expect them to be, it means that these businesses can better plan for their expansion. They can better plan in terms of borrowing. They can better plan in terms of investment that they will make into their business that will support and sustain their revenues and growth through the course of 2026, barring any impact of the pre-election activities that may likely occur. So if that happens, then output should improve and we should see much stronger growth numbers through 2026. But then again, it is a period that most people just like to hold on to funds because of the uncertainty with regards to how the activities will pan out. So we may likely see that reduced or somewhat slow growth in 2026. So there are a lot of other things that we expect to taper down, and we also expect that yields in the market, because of a sustained disinflation and a cut in policy rates, will also affect yields in the market, that's in the fixed income market, and that should bring down the level of borrowing, like I earlier mentioned. So we are positive broadly, but then we understand that there are some factors that we need to watch out for because of what we have seen in other pre-election years that have passed.
Thanks for that breakdown. Before I let you go, you've touched on very, very important issues there, pre-election here, and everyone expects that government's focus and all. But moving on, we expect another inflation figure. I think we should get one more for November before the end of this year, and the next one will come, of course, in January before December. Now, considering the December spending, dirty December, everyone is already talking about it. People are already coming to Nigeria. So all tickets booked. Everyone is coming in. And, I'm thinking that, would that have any effect? Some say we might have a bit of maybe spike in our inflation figures, and that might change some arrangements. I don't know if you're thinking along that line.
So there are two figures we're expecting for 2025. We have the November that will be coming out next week, and we know November has already passed. So there's no much spending in terms of as you put it, dirty December. Yes, we are going to see it more in this month. So that for November, we're expecting a sustained disinflation because our in-house projection for November is around the levels of 14 to 15% inflation rate year on year. However, for December, when it comes out next year, January, we're expecting a much higher inflation rate. And it's not necessarily because of, the spending that has increased or that is likely to increase because of the festivities that, December is packed with. It's also going to be as a result of the low base we are coming from, because we're computing year-on-year inflation for December because of the rebasing that we did for the CPI in 2024. We're going to be having an inflation rate of around close to 30%. And that is just largely as a result of the low base and very little of the spending that happens in this month. Because like I earlier mentioned, year-to-date inflation is currently at around 28%. So if we add month-on-month inflation to that month-on-month increase in the CPI to that, we may likely end the year at around 29 to 30% for December, which will come out in January. And that is just because of the low base based on the CPI rebasing that happened. So that is our expectation with regards to inflation.
Nabila Mohammed, always interesting having you on the program. I must thank you so much, investment analyst Chapel Hill Denham. Do have a great day.
Thank you for having me.
And enjoy your December.
Okay.
All right, then now still to come on the